Good morning, everyone. Thank you for joining on Saturday morning. My name is Rashmikumar Shah. Uh, I'm doing this webinar from Dallas, and it's almost about 12:30 in the night here. But I enjoy talking to you guys and connecting with you, everyone in India at this time. And the standard disclosure that this webinar is not for people residing in North America, and we are not promoting any investments in Canada or US. This is only for people residing in India. And yeah, so let's start. I really appreciate you joining us, and those who are going to watch later, thank you for logging in. And if you like our webinars, please do subscribe to our channel. It helps us in investing more and more on this kind of technology and research and talking to you guys. It helps all of us, correct? Now, this is the 10th year of Simplicity. Simplicity was incorporated in 2011, 23rd June. So my first seminar, at that time it was not a webinar. I used to do seminar in Pune. It was in October or November of 2011. So I revisited that PowerPoint, and when I saw that, I smiled. And so I'm going to capture some of that text of that PowerPoint, and I'm going to show and compare what happened, correct, in last 10 years and what I see next 10 years. So what I'm going to talk about today. Now today's webinar has slightly little bit more slides than the normal slide. Normally I do only about 20 slides. Today we have 30 slides, so it will take some little bit more time. But there is a lot of data and there is a lot of information, and I'll go slow. And feel free to ask me questions at the chat box on your screen. You can post your questions anytime, and at the end of the webinar I'll take that, correct? Today you'll have to be a little bit patient with me because there are a number of slides more, but it's going to be an interesting journey because I'm going to talk about 20 years, past 10 years and the future 10 years. Now, Simplicity's first presentation of 2011, what we saw that time and what we anticipated. I'm going to share some of those data points. Then how we saw the wealth advisory business in 2011 and what it is today, correct? Now, how Indians used to invest in 2011 and how Indians are investing today. That data also I'm going to share. What has changed in wealth advisory business, or wealth creation, or wealth management, or whatever you can call it, in the last 10 years. So I'm not going to talk from the SEBI point of view or the market point of view. I'm going to talk about how, from the investor's point of view, what has changed, correct? From your perspective, what has changed. Now, how the different assets classes have performed in the last 30 years. So what are those 5 asset classes? Those are gold, Indian equity, Indian bond, cash, and US equity. So those 5 asset classes, which has performed how in last 30 years, every year wise, and how strong is India's growth story. Unfortunately, we are going through a very bad health crisis in the world and especially in India. But how that health crisis has reshaped our India growth story, that I'm going to talk about it. And what are the key drivers for growth for next 10 years? So what are the positive things we have to look at next 10? Of course, we are going to have challenges. Life is full of challenges. Life is never without challenges, but life is also about very good positive surprises, correct? And there are a lot of good things going to happen in next 10 years. So what are those things? And what are the stocks and sectors we chose to invest in 2011? And how that has changed, or has they changed in 2021, that I'm going to share. So there is a lot of information. So this is the storyline which I'm going to talk about today, correct? So let's begin, and I hope you enjoy it. The first thing, Simplicity in the 10 years journey, correct? So when we started in 2011, one of the promoters was Mr. Steve Atreides from US. He and myself used to spend every day 4 hours in the library in US, and on the drawing board we used to say what we'll do, what we won't do in India, and how investments we'll do. So that time we noticed that Indians never invest. They'll invest 100% locally. no one was aware that even you can invest globally. There are only one or two funds. One was by Birla and then one was by ICICI. Only two funds were available in India to invest globally. And we started that inside that you need to invest globally. So that was a theme. So this was my first presentation. This slide, that time also Windows and PowerPoint was different than what it is today. Today it is much more sophisticated and much more digital. And so what we did is we updated that PowerPoint presentation slide here, screenshot I'm showing you, the art of globalizing your portfolio. This was in 2011 slide. And so how we saw the world that time, correct? So Simplicity Investing Outlook in 2011, what was that? In 2011, as I said, 100% transactions were local and every investment in mutual fund was physical. There were no digital. No one was investing through NSE platform or BSE mutual fund, or there was no online. Everything was physical, except for direct equity, which was demat. Some digitalization was there. Otherwise, everything was physical, and onboarding was physical. So we had to meet every client in person. You had to have physical presence in everywhere, every city to meet a client, and then only a client used to invest. Today, that's not the case. Real estate and gold were at peak, correct? They were the flavor of the time that time, and hardly any awareness was mutual fund was there compared to the global standards. And investing in insurance products and was more popular than investing in equity mutual funds. So ULIPs were much more popular than equity mutual funds, and especially investing in global companies like Microsoft, Google was practically zero. There was zero awareness of that time. So we were surprised by that everybody in India uses Microsoft, Google, Apple, Facebook, but nobody was even aware that they can invest and they should invest in that. That surprised us. So this was a slide I made that time, that in 1970s, when I was in college or school, I graduated in 1981 as a chartered accountant. Phones, Vespa scooter, this Rajdut motorcycle, or and the Fiat car. So out of this, I made this is a statement I made that time, that out of these four things, if anyone, that I was in college, correct? So I said, if a college kid had, out of these four, any three thing had, any girl would be ready to marry me that time. So those were, but now if you have those things in 2010, they says, what an old fashioned guy, correct? They won't even talk to me. So 2010, the consumption was, you had an iPhone, you need this Honda Activa, you see this motorcycle, or need Honda Accord. Everything had changed in 2010. Consumption pattern changed, but the investment pattern hadn't changed. We were still investing in real estate, gold. Those old products were very popular. So that was one thing we noticed in 2011, and we started focusing on that. I said, no, you need to invest globally. We need to change your outlook, and that was the theme of my investments in 2011. Now, has that changed? Not much, really, correct? Today, the mindset of clients has changed a little bit. Now, currently, we are 100% digital. Today, we don't require, say in last 1 year, our business has gone double. We are acquiring more clients in last 1.5 years than we acquired in previously. Acquisition has become 100% more, and everything is through digital. We don't have to meet. We do webinars, we do Google Meet, team meetings, Zoom meetings, and clients close. And we don't even a client who wants to invest 2 crores, he doesn't visit our office. So now today that has changed. Physical, so that has saved a lot of time. I'm in America since last February. I have not come to India, but I'm managing my business, my team, everything from here. And I'm telling you, my productivity has gone up by 100% more, because I don't have to waste my time in commute. I don't have to. So efficiency has gone up, productivity has gone up, everything has changed, correct? The physical. Now, today it's more important to have more social media presence on social media, rather than having a property in Colaba or Nariman Point or MG Road. So the investments, you don't have to make in prime locations. You have to make in prime websites in technology. So that has changed. This too is a very drastic change, correct? Which was not there in 2011, 12, 15. We required physical presence, prime location offices. That is not required now. Because of this change, the reach of business has become global. Today, like I was talking to someone today morning, that last week we acquired clients from 3 different countries, correct? And I'm in US and the clients are in different parts of the world, and we acquired them, correct? So in different parts of India, correct? We are closing clients in Hyderabad, Bangalore, Ahmedabad. We don't have any offices there, but through webinars and Google Meet, we can close that. So the reach has become global, which was not there that time. And Indians can now also, as an Indian, you can invest anywhere. You can buy Microsoft, you can buy Russian oil company, you can buy Brazil stocks, you can buy. So the reach today, all those kind of products are available in India. So they have a lot more options. And now, in 2011, I had competition with my local peers in Pune, Bombay, Aurangabad, wherever I was. Today, my competition is not only from local players, it's from global players. So today, the competition is much more. So the quality of a service, the quality, everyone who's in this business, they have to upgrade the quality. So awareness, knowledge, the service standards, everything has gone up. So that's a positive thing. I see a lot of things has happened that way in last 10 years. This is a one major change we are seeing, correct? But in spite of that, I'll show this next slide. I got this slide yesterday. I got this data point yesterday while doing some research. In 2020-21, I'm talking about 2020-21 financial year. This is the data published by RBI. Of the total savings done by Indians, 58% of annual savings went in gold and real estate, physical assets. So if a person saved 100 rupees last year, he spent 58 rupees in real estate and gold, and 41% savings went in financial assets. Of that 41%, only 2 rupees went in mutual fund and 1 rupee went in shares and debentures. So this was shocking. Only 3% of savings, whatever savings Indians did last year, went in equity mutual funds and shares. 97% of the savings went where? Now, as against this, if you see America or you see Australia or any developed nations, 60 to 65% would have gone in financial, stocks and mutual funds, and less than practically 2% would have gone, 2 or 3% would have gone in gold. Now, it's very different, correct? It's very different. So in India, this trend has not changed, unfortunately. So if you see from month of July till month of March, retail investors in India were redeeming mutual funds. Oh, why the market is going up? There is so much bad news. And they were booking profits and getting out of the market. Whereas the foreigners were investing. The foreigners were more positive on India than we Indians were. So that was the case last year. Even the foreign financial institutions are more bullish on India today than Indians are. Now, I consider myself a global citizen. The way I look at from India here, I'm more bullish on India than even US today. So I have been investing. My personal investments are all over the world. I invest 60% in US, but currently I'm more bullish on India than on America. But Indians are still not investing in India itself, correct? That's the unfortunate part. So this trend was there in 2011 and it's still there today in 2021. Now, in fact, because of whatever reasons people have give COVID or whatever. So this is a surprising data which I saw, correct? Still, people are hooked up to gold and real estate. In America, people have only one homes. They consider real estate as a physical young generations in America, they don't want to buy real estate. This is becoming like a cow, getting tied up to a tree. I can't move. Then I can't move from one place to another. My job mobility goes down, which is not the case in India. People are first thing they want to do is investment in real estate. That trend has not changed. The So patterns have still not changed, correct? So now if you take the India's balance sheet, now this is, I'm looking at a different way. Last slide was about savings, correct? This is the balance sheet of Indians, correct? So if you take any family's balance sheet, 30 to 35% is still in bank CDs and savings account. I'm talking about India as a whole, correct? India as a whole. Savings and insurance and pension accounts is 30% still. Saving in postal savings and government bonds is 13%, whereas savings in mutual funds is only, which has gone up from 3% to 7%, and savings from international fund was zero. Now it's gone to 1%. Savings in income and corporate bond, that is debt funds, has slightly gone up, correct? Now this is the trend. So basically nothing much has changed. We are still way behind the global trends. We are way behind global trends. We are way behind international standards. So we will see that change happening in next 10 years. It may not come to that international level like US or Australia or Europe, but we'll be going further up, correct? We'll be moving further up as India modernizes and more people, more and more education and awareness of this happens. The participation in equity investment was very low in 2011, was less than 1%, as I said. Today it is 5%. 5% of population is participating in SIPs, correct? So SIP awareness has gone up. So this is the numbers of people, correct, who are aware of it. Asset rebalancing, 2 or 3%. That time it was less than 1%. But overlap of mutual funds. So what I mean by overlap of mutual funds is still very high, 90%, correct? What I mean by overlap of mutual funds, there are 40 mutual fund houses, and investor will invest large cap of 5 mutual fund houses. So he'll invest large cap of Birla, Nippon, large cap of Axis, Mirai, and now what happens is all this large cap of or multi-asset or whatever those generic vanilla funds are there, they have 80% stocks common. So it's like, I'm eating idli in Rupali in the morning, then eating idli at 11 o'clock in Vaishali, then eating idli again at Shiv Sagar, but I'm eating idli only, correct? There is no diversification. So that is, we see this every day. When we see every day, the stocks are common. Now, just buying different fund houses, mutual funds, doesn't mean that you're diversified your portfolio. The portfolio diversification means the stocks are not common. Underlying asset is not a common, which awareness is very less in India today. Now, there are various reasons why that is happening. Just buying mutual funds from 20 different fund houses or 20 different schemes, that doesn't mean you're diversified. That doesn't mean you have diversified. We have seen client accounts when new clients coming to us having 200 folios, 250 folios. It's a mess. It's a mess, and that's the situation we are still seeing. At Simplicity, we don't allow that. We invest only in 5 or 6 schemes, and no stocks are common in different mutual funds. We don't do that because it doesn't make sense, correct? It doesn't make sense. You can't eat at least from 5 different restaurants. Ultimately, your stomach will get spoiled, correct, if you do that. Now, the other thing, inflation is a challenge. People don't understand the impact of inflation on their portfolio. If inflation is 8% and your bank CD is giving you 7%, that means you're getting negative 1% return. And plus on a bank interest, you're paying 3% tax, correct? 2% tax. Just because you don't understand stock market, you don't understand stock markets are volatile, it doesn't make sense. So bank interest rates, though they have come down from 9% to 6% on average, this is inflation. Bank interest rates have come down from 9 to 7. Still, a lot of investments are going there. Corporate FD rates are from 10 to 8. This I'm talking about AAA corporates like HDFC and Bajaj. I'm not talking about B category of corporate. They are very risky. One should never invest in them. Rupee depreciation has gone up on average to 4% per annum. The Sensex, which used to give from 80 to 2012, about 19 to 20% return annualized, was giving only 4% to 5% return from 2011 to 2020. Now it is giving 10% return historically, if you see that way. So these are the, I won't go through everything here. The household savings, only one thing which I have noticed, the household savings rate has gone up because of the COVID and pandemic in the last 1 year. And this trend is there worldwide. So the savings rate has gone up. People are spending less money and they're saving more, higher portion of their income. Of course, because of COVID, correct? They can't go and shop, they can't travel, and expenses have come down, and that's why the savings rates have gone up. But most of these savings are getting parked in bank deposits, insurance, and gold and real estate. It's not come to stock market yet. That trend we may see. Now, this next slide I'm talking about, what people ask me, what is the safety level that once I have this much money, I'm safe for my retirement? So I'm sharing here a slide which is of international standard, which globally in America they say that if you have $1 million of financial assets, your retirement is secure. So $1 million is 7.5 crores. So if you have financial assets, I'm not talking about equity mutual funds only, I'm talking about your PPF, your bank deposits, your insurance policies, all financial assets, excluding gold and excluding physical gold and excluding real estate. If that is more than 7.5 crores, you are considered to be very safe. Now, what percentage of population in the world has that? Only 1% of population has that. But that 1% population has 46% of the world's wealth. So now, the second batch level is saying people who are having financial assets of 75 lakhs to 7.5 crores, 11% is there. I would say in India, if you have 3 to 4 crores financial assets, it's very safe. You can enjoy retirement life. In America, you require minimum $1 million because the cost of living is very high here. But in India, if you have $500,000 is 3.5 crores, you should be fine. You can have a very good quality of retirement life. So what population in the world has that? 11%, and they control 13%, but the rest are here, correct? So if you have less than 7.5 lakhs financial savings, you are in the 55% of the world's population, and they control only 1% of the wealth pyramid. So remember the benchmark. You don't require more than $1 million. If you have more $1 million, you can really have good quality of life. So if you have financial assets of 7.5 crores, now let me tell you, it's not difficult to build that. If at the age of 25 you start with a 25,000 SIP rupees, I guarantee you will have 7.5 crores by the time of retirement. So, and we have seen this in our simplicity. Clients who have started in 2014 and 15 with 25,000 or 50,000 SIP, today are having 3 crores and 5 crores in their portfolios. It's not a difficult, it's just following the discipline and maintaining it and not worrying about the market, not focusing here and there, and having less number of assets. Now, so to secure a retirement, this is the benchmark globally. Globally, I'm telling you. You should be fine, correct? You don't have to do an expert retirement planning, giving you a 100-page report. Means then they are selling you something, correct? Retirement planning is very simple. Very simple. If you have financial assets of 3.5 crores, you are secure in India and you don't have any liabilities, correct? As simple as that. Now, upper middle, so why it's stopping people from doing that? Because the investment profile of Indian people, our culture in India, we have been brought up gold, correct? For centuries, we have been buying gold. 25% of world's gold purchase is done by in India. 30 to 40% investments goes in real estate, and that those real estates are not used. They're lying idle. I have seen families buying a 2 crore flat and renting it for 20,000 per month. Doesn't make sense. Oh, I have a flat of 1 crore and I'm renting it for 15,000 or 10,000 per month. I think the tenant is smart. The investor is, I don't know, I don't want to say anything about him, but it's a wrong investment decision. So that is the situation. 80% of investment public have more insurance policies than stock and mutual funds. I tell my clients that after the age of 55, 60, you don't require life insurance policies. If you have more than 5 crores assets, you don't require life insurance policies. Don't buy life insurance like oh, mar gaya to lottery lagegi. Don't do that. Insurance policy is required, term insurance is required when you are 30 years old. Insurance is not, old car doesn't need an insurance, a new car needs an insurance. So the concept of insurance planning in India is very, I wouldn't say people are not that savvy. Even health insurance, if you have more than 7 crores or 5 crores in financial assets, I don't buy health insurance in India. I can afford to pay 5 lakh rupees hospital bill. Health insurance is required for people whose cash flow is not there. So when a 30-year-old young couple, they have earning 1 lakh rupees per month, and if the hospital bill comes 10 lakh rupees, then there's a problem. They require health insurance. Health insurance is not required at the age of 60 when you have 2 crores or 5 crores and you're spending 1 lakh rupees in premium. It's a waste. So you need to, the education and awareness is not there. So only 3% of people in population invest in stocks, correct? So there is a very low. This has not changed. This has not changed. It was in 2011 the same. Today it's same. It might have slightly changed in cities like Pune, Bombay. But if you go to interior India, it is the same. Nothing has changed. So that education is about to come. That we'll see in next 10, 15 years how much change happens here. Then, as again, when they invest in stock market and mutual funds, still the performance is poor. Now, the performance is not poor because the markets didn't perform. Even if the markets have performed, markets have given compounded 10% return for last 10 years. Prior to that, they have given 20% return for last 30 years, from 80 to 1980 to 2010, correct? In fact, if somebody stayed invested, the CAGR of the Sensex is 14%, 14.5. So markets have performed, but people have not performed because they try to time the market, they try to trade the market, and they don't do wealth planning properly. So if wealth planning is working on a plan and sticking on it, correct? You go and catch a train for going to Delhi, and you stay seated in the Rajdhani Express. You don't keep on changing the train. You don't say halfway, नहीं Delhi नहीं जाना है, आज नागपुर जाना है, नागपुर नहीं आज मैसूर जाना है. You don't do that. People keep, but when it comes to investment, they keep on changing the trains. Then you reach nowhere, correct? And you can't blame the train. You need to follow the process, and that's the problem. Then many of the, what happens is there's so many investment products in India, and everybody wants to sell. So every institution, every media has some conflict of interest, and they publish, and people follow that. And most of the people, they invest in most advertised products. People get some in the news. So we tell people, once I'm getting married, I'm married, and if the Panditji comes and shows me another proposal, so should I look at it? No, correct? So same way, you focus, identify some investment and stick with it. Don't keep on नया क्या है. People keep investing in new NFOs, and this doesn't make sense. We don't, in simplicity, since 2011 till today, we have not invested in a single new mutual fund offer. We never invest in any new NFOs. We don't invest in any new IPOs also. नया क्या है, you can't do that. Stick to quality, follow the process. And that is one of the major reasons of poor performance, correct? And random investing, having too many items doesn't get you diversification. Over diversification means you get national average. So national per capita income of average India is how much? $2,000 per year, correct? So $2,000 is how much? 1.5 lakh rupees. So if you randomly do the investments, you will get a national average. So you will get that very low performance will be there. Don't do that. the 1% or 2% of India's stock population, the income level is much higher. So same way, your investments should be of that caliber, correct? So follow that. So this is the major root cause of the poor performances. I'm not going through everything. And people don't understand how inflation affects their portfolio. Understanding the impact of inflation, you have to that. You don't have to be fearful of inflation. What I'm trying to say is understanding the implications of how inflation affects the valuation of your assets and how taxation affects. And you need to look at very professionally, correct, objectively, and that is not there, correct. So this is one of the stuff I have seen then. So why do investors fail? Because they don't have plan. 80% start trading in stock market, no education, correct? So that's why, most of these channels, they promote buy this, sell that, buy this, so that is trading, correct? Now the channels have to keep doing this because it's their business, then only they'll get advertisements, correct? They have to every day keep generating news stories, so people will watch television. I don't watch television. I don't, in fact, this month I'm cancelling my cable television in US. I'm sure because I never watch television. I watch only what I need to read, correct? I go to sit on my computer and watch. I spend more time on YouTube, and I read what I want to read, correct? I don't allow television to tell me what I should see. I want to see what I need to see, correct? So I don't spend time on television. So that's why in America they call television the idiot box, correct? It gives you garbage information, and then you start believing in it. I don't do that, please. Analyze the data, and people start trading, correct? There is a difference between trading and investments, correct? Investments is zero trading. See, Taj Mahal for 400 years was there, and today it's there. How many times it got traded? Never, correct? So you buy quality investments and stick with it. You got married once, correct? And you stuck with it, correct? You are not trading, correct? You are not shuffling your spouses. Same way, investments, you should not do that. Stick with it, correct? So people keep on telling us, in last year, markets were volatile and we're doing that. We made everyone stay invested. We didn't allow clients to book profits. So we did very well. We did, and we anticipated that, correct? We anticipated that. So before client comes to us, we go to them and tell them the portfolio is doing good. You need to stay invested, or if you have more money, invest more, because we are optimistic of the market. Don't go by the COVID news. And you have to educate that, correct? So we did that, and we did very well. Portfolios have gone up by almost total assets under management has gone up by 100%. So the returns are very good. And when returns are good, people say, should I book profit? I said, no, still the story is yet to begin. I see next 10 years very good. So something is working, why stop it, correct? So don't trade, correct? Stay invested. Now, when people come say, okay, Mark, I'm getting such a good return, why shouldn't I book profit? I said, if Kohli is hitting century after century, why want you to take him out of the team? अरे नहीं, वो 3 बार सेंचुरी मारा तो नेक्स्ट मैच में नहीं मारेगा, तो उसको बिठा देते हैं अपन. Do you do that in the cricket team? No. If he's hit centuries in previous 3 matches, he becomes a core team player, correct? Because his probability of hitting a century is much higher than other players, correct? So keep your winning players in the team. Don't try to do that. So our way of profit booking is very different than most of the people think. And poor risk management. Now, we don't look at returns, we look at risk. So risk is the most important thing. Like, flying through an aeroplane is more risky than traveling through train or traveling through bicycle or driving a car. But more people get killed on road accidents than plane accidents. Why? Because the risk management in flying is very good. The risk management in flying is very good, correct? So same way, in investment, markets are volatile, but we have very good risk management. So your risk management is more important. And most people blindly invest, assuming that everything is going to go up, and they prefer penny stocks. They prefer small cap, we don't invest there. We prefer expensive quality managements, quality stocks. Cheap is always cheap. You can't build a Taj Mahal with a cheap material, correct? You can't build a monument. For building a Taj Mahal, you need granite and marble of the best quality in the world. Same way is about your portfolio. You need the best companies of the world to build a portfolio for your retirement. Cheap is never always cheap, correct? So here's the example of investments in quality management versus ordinary management. So Diwan Housing. So I'm comparing Diwan Housing and HDFC. I remember in 2004-5, Diwan Housing was 12-14 rupees stock, and many people were saying invest in Diwan Housing. I said what? I'll pass that. HDFC. So from 2004 till 2018, Diwan Housing and HDFC, they perform similar, correct? So, but most of the retail investors, they prefer Diwan Housing because it was cheaper, low price stock. But see what happened. One day, a poor management is always going to crack today or tomorrow. Sometimes it will crack in 5 years, sometimes 10 years, but eventually it will crack, correct? And that we have seen so many poor managements went bankrupt in last 10 years. So when it cracks, see what happened. See the gap, correct? How the wealth destruction happens. Reliance Capital was 2,500 stock. Today it's 5 rupees or 10 rupees, correct? And people are still buying it. I said, why? Correct? So it was a 2,500. See the wealth destruction. A 2,500 has become 5 rupees. See Yes Bank and HDFC Bank. Correct? I have never invested in Yes Bank in my life. Never. I'm not talking after the fact. Correct? Why you want to invest in those kind of stocks? Correct? Build the portfolio. So, okay, this is a very important. This slide I came across yesterday. Which family has given the maximum donations philanthropists in last century? I was shocked to see Jamshedji Tata. He has given more money than any of this Bill Gates or Warren Buffett or any of these well-known figures, correct? So, see the Tata group of companies, how they have performed last year. Invest in those kind of quality managements, correct? This group, they share wealth with the people, with the nation, correct? They are nation builders. Invest in those. They are not creating wealth for the family. They are creating wealth for the nation. So there is a difference between promoters who are creating wealth for the family and promoters who are creating wealth for the nation. Invest in companies where promoters are creating wealth for the nation, not for themselves. So that's a very quality management, we call it, correct? And they are very easy to figure. Now those investments are boring investments, correct? Because those who create wealth for their family, they always come in the news. उनके घर में शादी हो गई तो वो मीडिया में आएगा. Have you ever heard any Tata family marriages anywhere? But you have heard all the other marriages, correct? You come to know where to invest, correct? So focus on those quality managements and build those kind of stuff. So the road ahead, this thing has not changed in last 10 years. The reason I'm talking about this is in last 10 years, that has not changed. But what is going to change in next 10 years? The future is very bright for India. But you can make money on that future bright only if you follow the track and you stay on the plan. If this train goes off the track, then what will happen? Accident will happen. It will not reach the destination. Same thing is about your money. Keep your wealth process building on the track. Don't get distracted by the news coming. Profitable karo, ye karo, switch from this to that. Don't do that. Please don't do that. Now I always give this example, correct? Let's say I'm married, correct? And someone, the Panditji comes and tells me, Rashmi bhai, your wife's horoscope is bad for next 7.5 years. So, 7.5 hai unka. So should I give her divorce? You go out for 7.5 years and then we'll get remarried? No. If it's she's a spouse, she's good, work with her, correct? And go through that bad phase. Now, if you are invested in good companies, good sectors, stay with it. Because don't try to, wo bech ke wapas nahi chulunga. Don't do that. Because the cost of doing the transaction is 10% capital. People don't realize बेच के मैं वापस लूंगा, so there is a capital gains tax of 10%. So the straightway transaction cost goes off 10%, correct? So it's very expensive to do that. They don't realize all that kind of stuff. You need to look at, so stay focused and stay. Now, this is the slide from my 2011 presentation where India growth story, and these are all the magazines which were promoting India and what they were saying, correct? They were saying India is the youngest population in the world and next 2 decades are going to belong to India and all that. So foreigners were more bullish about India then and they are more bullish about India today. Now, 80% of the FFIs, okay, there are two kinds of FFIs. Indian promoters routing their money through FFI route. I'm not talking about those FFIs. I'm talking about the genuine FFIs, pension funds from America, pension funds from Europe, who are long-term investors in India. They have not traded in their core portfolio. 90% of the portfolio they have never sold. They keep buying year after year after year. Those investors, they are extremely bullish on India. And that's why FFI investments, today FFIs control 25% of equity in India. Out of 100, retail investors have less than 6% equity in India. So you can see that, correct? So this was a story of 2011. That growth story is still intact. In fact, it's become more bullish now, correct? I'll share that with you. Now, the other thing, the culture change has happened in last 1 year after COVID. 2010 to 2020, US outperformed India, but now they are saying India is going to outperform US. So there is a cultural shift. There is more positive news getting talked about India in US than the positive news getting talked about India in India. So in India, positive people spin political things. I'm not talking about political this thing. Stay away from politics. Don't mix your politics ideology with your investments. Keep that aside. Investments should be done purely based on economics, not on ideology. But what I'm trying to tell you is, if I look at the globally today, India is considered to be one of the best investment destinations, correct? Now, why they are not putting more money in India? Because India can absorb. There is not much scope. If everybody from abroad wants to invest in India, even the allocation to India is even today less than 1% globally. Now, if they want to increase the allocation of 1% to 2% to India, that not that many companies in India which can absorb that kind of capital. So the money is going to keep coming to India, and FFI investments, portfolio investments keep going to come to India. You don't have to worry. India is modernizing, as you see in this chart, correct? This is some, one second. India is modernizing, and this kind of buildings were not there 20 years back or 10 years back. And you will see a massive change happening. So we need to modernize your investment psychology also, correct? Now, the consumption pattern in India has changed. What is going to change in next 10 years? The consumption pattern. So, when your per capita income is low, more money gets spent on food, correct? As you go from the basic needs to affluent society or elite society, your food expense plays very small role, and the other education, leisure, travel, health, all those expenses go up, correct? And this increases the reach of the, so this expense is going to go up. This economy is going to go up in next 10 years, and there is a massive shift happening. Now, I'll give you another example. I'll give you a classic example here. So, 40 years back, my grandfather, my father, and I have 3 sisters. We were all living in one house, and my father was the only earning member. So my grandparents 2, my parents 2, 4, and we 4 kids, 8. So there were 8 people living in one house, and there was only one earning member. Correct? Only one earning member. Now today, we're all 4 siblings. All 4 siblings got married. Our parents are not dependent on us. our spouses and I, we both are working, so it's a double income family, and we have only 2 kids. So the number of earning members per family has gone up. It has gone up 200 or 300%, correct? So when the number of earnings per family, the family size has become small, and the number of people earning in the family has gone up, the capacity to spend money goes up. So GDP goes up, correct? So that change is happening, and that change is going to accelerate. I'm saying it's going to accelerate in next 10 years, because double income family is going to be more and more, correct? As more and more women come to workforce in IT sector, in all of the services sector, and the number of children, the family size is going smaller and smaller, correct? So the earning per family is going up, and this is going to boost the Indian economy. And this happened in America in 1950 to 70, and that's where America replaced United Kingdom as the number one economy in the world. This happened in China in the year 1990 to 2010. That's where China has become number 2 economy in the world, and in India it's happening between the period of 2015 to 2035. So in next 15-20 years, India's profile is changing, and this is going to change, correct? This is very important for you to understand, and that's why the markets are going to go up. That's why, and also with technology and all this kind of, people are buying more branded products. Big companies are gaining market share, and consumption is going up. So this is all impacting organized economy much more, correct? Now, here how different asset classes have moved over the years. So this is from 1990 till 2020. So if you see between 1990 to 1994, equity outperformed number 1 every year, correct? You see that, and gold was now 1995 to year 2000, when we didn't. So 1991 we got Narasimha Rao as a prime minister, and we had a stable government, correct? And maximum reforms took place. So this, correct? Now then 1995 till year 2000 we didn't have a stable government. We had a lot of new prime ministers, correct? Only in the year 2000 we got Atal Bihari Vajpayee, and from that to 2004 we had a stable government, correct? 2000 to 2004. Then from 2004 we got a Congress government, and till 2014, correct? Now you see, during that period the stock market, most of the time Indian equity performed better than US equity and any other asset class. Last 10 years it's only one time we performed, in 2017 and 2014 when Modi got elected. Last 4 years have been bad, correct? So in 2018 equity was the worst performing. 2019 equity was the second worst performing. 2020 Nifty gave 15% return. I expect equity to be the best asset class for in 2021 and 2022. So be prepared to that. So every other year equity was the best performing class. In last 10 years we had only 2 times. So you will see that pattern changing and going back to the normal pattern in the coming years. So you need to keep this picture. So I have been saying this last 2 years also. When gold outperforms Indian equity for consecutive 3 years, next consecutive 3 years equity will outperform gold. You see, that is the pattern. You see this pattern anywhere, you'll see that analysis. So this is a very good macro chart. When you are in a relaxed mood, visit this again and think through. You will see the pattern, correct? So this I'm expecting the equity to perform very well in next 2-3 years. The other thing, people are talking about inflation, correct? So our service sector is 70% of India's economy, manufacturing is 24%, and 5% is agriculture, correct? Now if you see, the services had the maximum inflation in last 40 years. So where was that? So services, manufacturing and agriculture hardly had any inflation, correct? Going forward, we'll see more inflation year and year, and there'll be less inflation. So I'll show you that in next slide. Why? So if you sorry, that is later down the line. I messed it up. The other way, other thing, the economic cycles go up and down, correct? So in 2019, the cycle, correct, was year over year. U.S., China, and India was bottoming out. Now this up move cycle is here again, correct? So today, all these four economies are in an up move cycle. So the global economy is on the recovery mode. Yeah, India is the laggard of that, but it will catch momentum in next 2-3 years. So we are in the up move now, correct? We are in the up move and in the early stages of the up move. So many people tell me, oh, index is at 53,000. Should I? 53,000 is just a number. During 1980 to 1990, the index doubled every year. So 1980 the index was 100. In 1990 index was 950. So in that 10 years period, index gave 950% return. 950% return, correct? Index has doubled in India after 2014. In 2014 it was 25,000. Today it is 53,000. So in 7 years it has doubled only once, correct? So we'll see the momentum now. We'll see the momentum happening. So be prepared for that. Don't look at that 53,000 number. Here's that inflation slide I was talking about. So in last 1990, if you take the base, the highest inflation has been in the education. So I graduated in 1980. My college fee used to be 2 rupees a month. I became a chartered accountant. Must have spent not more than 100 rupees for my entire course, or 200 rupees. Today, a chartered accountant, to become a chartered accountant also, people spend 20 lakh rupees. Forget about doctors, they spend crores, correct? My daughter, I don't want to talk about that. We had to spend $500,000, correct? $500,000 is 3.5 crores. Education has become the most expensive. Highest inflation was there. TV prices, see the call, they have crashed, correct? And the quality of TV has gone up. So toys have gone down, software has gone down, wireless services, phone. In 1995, the phone charges, we all know how expensive the phone was, correct? Even the local calls, you remember the PCO booth and that, the minimum charge was 1 rupee. And that was for per minute. Now we hardly pay anything, correct? WhatsApp is free. The charges have come down, correct? So you see the inflation was not here. The inflation was in education and healthcare. Next 10 years, the inflation, this is going to come down. This is going to come down. This is going to go up. We will see inflation in manufacturing products. You will see inflation in food products. But that is only 30% of India's economy. 70% is services sector, where inflation is not going to be there. Inflation is not going to be there. So you won't see interest rates going up. The same trend is in US, and you need to be aware. Now, education, why inflation is not going to be there? Because of technology. There's going to be a lot of disruption, remote education. So people are not going to spend crores of rupees to get admission in expensive schools and colleges. Today, you can go to Mr. Google and learn anything, correct? You don't need to go to, if the objective is learning, you don't want a fancy name on your resume as a degree, but you want to learn, really want to learn. You don't even have to go for anywhere. You go to Google and you can learn anything there. So you'll see a lot of deflation pressures there. And so you need to understand when you are investing, correct? We need to understand. So this is, let me see, check the time, correct? Okay, fine. I'll finish in next 10 minutes. Globalization is now changing, correct? The other thing, what we are going to see, acceleration in technology. This technology is going to take, the world is changing because of technology. In COVID time, we could function because there was Microsoft, Google, Apple. If these technology companies were not there, lockdown was not possible. There would have been riots, more people would have died, correct? So technology is allowing, now like, let's say simplicity. Today we are able to do business because of technology. If technology was not there, physically, we couldn't have done during COVID time businesses. So technology allows you, and technology cuts the barriers, correct? It doesn't look at caste, it doesn't look at color of the skin, technology cuts through everything, correct? And that's the beauty of it, correct? You can't change a human being, but you can change the process. And that's how you can reduce corruption, you can reduce mismanagement through technology. So you will see more growth coming because of technology. And see the growth here. See the growth here. This is the technology cycle impact of technology through last 300 years. The growth because of the technology in next few years is going to be multifold. 5G, biotech, they're saying cancer, because of genomatics, cancer is going to be cured, correct? You will see technology impacting every aspect of our life. Artificial intelligence, space technology, correct? Who would have imagined 30, 40 years back that would be chatting on WhatsApp? I have grown up with a typewriter, correct? Today's generation doesn't know what typewriter is, correct? How many of you remember telex machines? In my first job, we used to communicate through telex machines, correct? No, there was nothing like email. Things have changed, correct? So, and they are going to change further. So this technology is going to, you take about this battery storage and data storage, correct? Day by day, my phone has become more powerful than the laptop, correct? Today I'm carrying, and the iPhone you carry your wallet, you carry biometrics, you carry everything. Driver's license, your insurance, you carry all your wealth, everything you carry in your phone. The phone is more important than your any other instrument in your life, correct? Any other equipment in your life. So understanding that impact of that technology on your investment is very important, and that's where many of us are failing to do that. So you need to invest in those disruptive technologies, disruptive industries, and that is going to be another challenge, correct? Building your wealth requires a plan. So this was the core foundation of Simplicity when we started in 2011. We said understanding of globalization, having a knowledge base, and understanding the demographics. As I said, that family structures are changing. If you understand that demographics and you understand how globalization works, and you can ride the boom, correct? You know where to invest, and your personality type and economic cycles then will take less importance. The most important thing is understanding of globalization, understanding how global trends work, and understanding how demographics work, correct? That is very important. Today, I'll give you another classic example, demographics of, correct? From last 100 years, the population grew by 700%, but now next 100 years, population is going to grow only by 5%. But the population of people above the age of 60 is going to grow from 11 crores to 34 crores. So what is that? People above 60 spend more money on services. So people below the age of 10, they spend money more on daycare, they more spend money on kindergarten and schools. Now that the number of kids are going to be less, the number of older people are going to be more. So understanding demographics matters, correct? So the economy is shifting, the economy is changing. You need to understand that, and the average size of family is becoming smaller and smaller, and the earning per family is going up. So which is very, so if you build your portfolio around these themes, you will do very well. So we build the portfolios on the theme and we stick with it. We don't change the portfolios. We have hardly changed our portfolio in last 10 years. I'm coming to that. Decision making should be knowledge-based process. It should not be based on emotion, and it should not be based on tips or insiders, correct? We'll keep getting more. Let me tell you, next 2 years, this year is going to be Olympics, but there is so much bad news, but Olympics is going to happen, correct? Now, world is getting adjusted to the COVID. COVID was a surprise news last year, so market corrected one time, and that kind of corrections don't happen every year. They happen once in 10 years. So we are not going to see that kind of correction now, at least for another 2-3 years or 4 years. And bad news is still keep going to come, but economists is factoring that, and markets are keep going to grow up. So you need to understand this. Next 2 years are going to be very good for the financial markets and the economy. Now in 2011, in 2011 we were telling all the clients to invest in companies like Microsoft, Apple, Google, healthcare, biotech and disruptive technologies, and we used to invest about 30 to 40% of our portfolio here, and we used to invest another 50% portfolio in this sector stocks. So we used to buy a banking fund, we used to buy infrastructure fund, we used to buy FMCG fund, MNC fund, correct? And these are the companies. So these were the stocks, we used to select those funds which had maximum, but there never used to be an overlap, correct? And in direct equity also, we focus only on this share. We never used to buy any penny stocks. We never used to speculate in penny stocks. We used to build a portfolio around this. That same preference, that list has not changed. Not much change has happened in 2021. Also, the same trend is there, except for few names here and there. We have added more companies like from power sector we have added, which was not there that time, and we have become more overweight on information technology, IT services. We have become more overweight. We have become overweight also on telecommunications, and this we have increased the allocation. We used to invest 15% previously. Now we make sure that we have at least 25% allocation to global equities. We invest that and we build the portfolio around that. And nothing has changed. And we see more, though India is going to do well. Remember, in India, Microsoft, Google, Apple, they grow faster than India's GDP. So if India's GDP is growing at 10%, Microsoft, Google, Apple, those companies in India grow by 30-40%. So sometimes you can capture India growth through buying those stocks also. Because India growth stocks doesn't mean those companies have to be owned by Indians. Today, technology companies, most of the technology which we are using in IT is coming from abroad, correct? So you need to understand how this works and build your portfolio accordingly. And with this, I am coming to end towards my presentation. Now here I am talking about one or two slides about how you should deal, correct? Focus on building your plan. Create a plan and stick to it, and keep improving it. Don't try to shuffle the portfolios, correct? This is the core strength of my. In spite of market going up, you may not make money if you keep on doing flip-flop. If you are trying to trade in the market, you will not make money. So this is the psychological trend, how people think. I've talked in most of my when markets are going up, they are in denial mode and they want to exit here. They want to exit here, correct? They want to go short here. And don't do that. Keep building the portfolio. Less is better for investments. Instead of having 20 mutual funds, having 5 mutual funds is better. Instead of having 20 stocks, having 10 stocks is better. Like previously, our parents used to have 10 kids. Now we have 2 kids, correct? Because why? Because it's better, correct? Better efficient. Same way, same principles apply in investments. Cricket team, whether it's India, New Zealand, Australia, we all have 11. We don't say India का population 135 crores है तो मेरे में 135 players होंगे. New Zealand will have only 2 players. No, it's standardized, correct? Same way, investments, you don't have to have too many items. Few items, but very selective, correct? Key to success in life is investing in patience. If you don't have patience, you can't create wealth. Please do not try to do the momentum market. We educate clients and so much, but still after that, market नीचे आया तो हम invest करेंगे. Market नीचे and when the market comes down, वो और नीचे जाएगा तभी invest करेंगे. And then suddenly it jumps up by 5%. They miss the bus. Now don't do that. Invest through a process every Thursday or every 5th of the month. Follow the process and don't try to do investment like a lottery ticket. Don't do that, please. You can't create wealth. Your money is like soap. The more you handle it, the less you'll have. Correct? Same thing applies with your money. The more you try to manage it, the less returns you'll get. So please do not play with your money. Do not let your emotions or what is happening in your personal life affect your decision making process. Stick to the process. And with that, I end my presentation. Thank you for your patience. Today there were a lot of slides. I hope you didn't get bored. Feel free to ask me questions. And of course the disclaimers here, correct? That we are not promoting any investments here. We are just talking about the trends and this. And please consult, do a professional this thing. And mutual funds are subject to market risk, correct? And if you like our presentation, please subscribe to our channel by clicking on that bell icon. So we can keep you updated. I'll try to do one webinar once a month. I'm ready to take questions. The first question I have, isn't gold a good dollarized hedge against the USD and INR? What is my outlook for gold, correct, for next few years? Okay, gold, if you're buying physical gold, it's not an investment, it's a consumption. But if you want to buy gold for investment, hedging against Indian rupee or this, then you buy a gold ETF, but that ETF should not be more than 3% of your portfolio, 3 or 4%. And you should not buy at one go, buy it through SIP, systematic route, but it should be only a certain percentage of your 2 or 3%. And currently the gold rally which was there last 2 years, I don't see that rally happening because inflation is going to be there, and the bitcoins also in US, and Bitcoin has replaced gold. So previously gold was the only hedge against dollar. Now there are multiple hedges against dollars. So the gold charm is there. I'm not saying it's gone, but you should not have more than 3% of your portfolio in gold. In my financial assets exceed 7.5 crores, can I retire safely and not worry about outliving my money? If your financial assets exceed 7.5 crores, then your priority should be that I tell everyone that if your financial assets are more than 7.5 crores, make sure that you measure them in terms of dollars, because rupee depreciates by 4%. So if 7.5 crores is $1 million, and on that $1 million, if I get 8% return, I'm very happy, very happy. So convert that 8% plus 4 rupee depreciation, 12. So if I get 12% return on 7.5 crores tax free, you're fine. Yeah. So that way you can build your portfolio, so you don't have to take the risk. 7.5 crores, and this 7.5 crores financial assets is excluding your house, excluding your real estate, and excluding your gold, correct? This is a pure financial assets. Yes, you're fine if you have 7.5 crores. It's a very good this thing. Should I get rid of my insurance policies in my financial assets exceed 7.5 crores? Yeah, absolutely. Because insurance, only term insurance you should have if you have any. But if I had 2 crores, I had a $1 million insurance policy in US and 2 crores. I stopped everything the day my kids graduated from college, and I didn't have any family responsibilities. So if something happens to me, I don't have to worry about my family. I cancelled all my insurance policies. I don't have any insurance policies as of today. So you do a risk assessment with some professional, and we don't sell insurance, so we are very independent. We are not biased. We are not against insurance also. We do a proper risk assessment, correct? And you do a risk assessment with us, and we'll guide you how much insurance if you need. If you have a loan, so if you have a mortgage or 3 or 4 crore mortgage, or if you have a business loan, to that extent you have a term insurance, I'm okay with that. But if you have no loans, you have no liabilities, and you have 7.5 crores of financial assets, and your kids are grown up, you don't need insurance. You don't need insurance. Absolutely. Because then you're destroying your wealth. Is not Next question, is not PE multiple in equity market too high? Some say it's the highest in the world. RBI, it seems have issued an advisory. No, it's relative, correct? PE again. In India, when RBI has issued that, it is talking about PE of only of the top 100 companies, correct? Now, if you take the PE of the top 100 companies in US, it's much higher than India also. You see the PE of Tesla, you see the PE of Adobe, you see the PE of Uber. They are all loss-making companies, correct? Facebook, the PE is much more higher there. So everything is relative. In India, we are talking about PE of well-established companies, correct? Growth. So there, the PE, again, there are PEs of two type of companies: growth companies and value companies. So the growth companies, which are in disruptive mode and they are in the early stages of growth, the PE can be high. P can be much more higher, correct? So I won't. P is not the only benchmark. Also, what happens is what P was there in 2010, because the liquidity was low that time. Today, the liquidity is high. Every government in every country has printed a lot of currency, so the liquidity is high. There is too much cash floating in the world, so the prices are going to go up, correct? So P is going to be high. So I don't think the P, I consider, according to me, P is reasonable in India. We have still room to go. No. Also the other way to look around, today very few people in Indian investors are buying equities. I would say the market will be when everyone wants to buy stocks, then I would say market's high. Today I don't see that happening. So if you see the data of mutual fund, go to any site, month after month till March, there were net redemptions. There were people selling only. There are very few people who are buying, correct? Very few. Only foreigners were buying, and they are continuing to buy because they see growth in next 2 years. I'll give you another example. Last week, I was talking to one of the executives of a mid-sized company in America. A mid-sized company in America is $3 to $4 billion. So that company, it's a manufacturing company, entire year's plan, what manufacturing plan or budget they had, that much products was sold out by the month of May. So that much pent-up demand was there for manufactured products. Now same thing is going to happen in India. So as Indian economy opens up, the pent-up demand for ACs, pent-up demand for automobiles is going to be there. Plus the normal demand is going to be there. So there is going to be scarcity of products. So the pricing power of all these companies is going to go up, and the profitability is going to go up. So next 2 years are very good for manufacturing companies. They are very good for other things. It's very good for information technology companies, because everyone has understood that without IT you cannot grow. I don't have to have a prime location now. I need to have a prime IT team. I need to have prime presence in the social media. I need to have a prime presence on the internet, so people can buy my product. I can reach all the customers. So IT spend is going to go up. We'll see that. So this is the thing which I don't think. And India is a growth. Next year they are saying India can grow by 12 to 13%, which is unheard of India, correct? Because all that pain which we had last year. Last year, India grew only by 2%. The corporate profits grew by 40%. So what it means is business moved from unorganized sector to organized sector. The same. And this year, as economy opens up, you will see more business moving from unorganized to organized. So the profitability of organized players is going to be much higher. Yeah. Any more questions? I don't see any more questions getting posted on the chat box here. With that, I end my today's webinar. Thank you for your time. And if you're watching this video later, this is going to be posted on YouTube, so you can watch it anytime from anywhere. Do subscribe. Oh, here I get one more question. Many investors in real estate use Airbnb as a source of secondary investments. Do you think investment in real estate in holiday destinations is good enough? Okay, good question. This is very good. Yes, Airbnb is very popular, and that has become. I know one businessman here. He has 150 properties of the Airbnb. So he invested in 150 properties as a professional team managing all those properties. Now, but that you can do as a business. Now, suppose if I was an IT professional, now I was a doctor, and I'm going to invest only one Airbnb property, then it becomes a headache and nuisance for me, correct? Then I will not be able to do my job properly also, and I have to manage that. So I would rather invest in Airbnb stock and forget about it, rather than buying one property and 30% of my time going on that, correct? So it depends on case to case. If you're going to do this full time, yes. But if you're going to do side business, side investments, no. Focus on your job, focus on your profession, be the best, and invest. Don't try to have a better picture, correct? That's my advice, correct? But it depends on case to case. And again, buying a property in a vacation destination, who's going to manage it? So you pay another 25-30% commission there. I wouldn't recommend that. I would rather focus on my job, and invest in those sector funds or stock funds and get a return there. See, today you don't have to buy real estate. If you're bullish on real estate, you buy construction stocks, you buy those sectors, correct? Why you want to buy physical? Because the cost of buying and selling a real estate is again 10%, correct? Stamp duty, headache. So in COVID time, if somebody wanted to sell real estate, not possible. But if you want to sell your mutual fund or stock, click of a button, correct? In 3 days you get your money. So look at that, correct? So you have to look at from different perspective: liquidity, ease of doing a transaction, managing that investments. There are multiple factors, correct? You have to look at that and do a professional judgment and then invest, correct? Yeah. Very good question. I appreciate that. Any more questions? Guys, if there are any more questions, can you let it know? If not, I'll end my presentation. Thank you very much. Thank you. Bye. Take care. Bye. And everyone be safe, and hope things turn out to be better in next few days for India and everyone else, correct? Yeah. Bye. Take care.